There is a retirement strategy that financial advisors love to talk about called transition to retirement, or TTR. Used well, a 60-year-old on a decent income can finish with tens of thousands more in super, but used wrongly, it can quietly leak money on tax you never needed to pay. Here is the catch most people miss. Once you start a transition to retirement income stream, your investment earnings are still taxed at up to 15% inside the fund, according to ATO Superannuation income stream rules for 2024-25. In a full retirement pension, those same earnings are taxed at zero, which is why staying in TTR too long quietly costs you money. So what is TTR really? From your preservation age, which is 60 from the 1st of July 2024, you can start a transition to retirement income stream while you are still working, according to ATO and major fund rules. It is what is called a non-commutable income stream, meaning you must draw a regular income of between 4 and 10% of the balance each financial year, and you cannot just pull out a lump sum. Here is where the magic happens for the right person. Take someone on $120,000 whose top marginal rate is 39%, including Medicare under 2024 to 25 ATO rates. If they salary sacrifice $15,000 into super, that money is taxed at 15% instead of 39%, saving about $3,600 in tax every single year. Move 1 is to confirm the maths works for you. Log into MyGov, go to ATO Online Services, then Super, and check your year-to-date employer contributions against the $30,000 concessional cap that applies from the 1st of July 2024. Then run the ATO tax withheld calculator twice, once with no extra salary sacrifice and once with, say, $10,000 to $15,000, and compare the difference. What good looks like here is being in the 34.5% bracket or higher, with genuine room left under your concessional cap. Income above $45,000 is taxed at 34.5%, including Medicare, and above $135,000 at 39% per ATO rates. The bigger the gap between your marginal rate and the 15% super rate, the bigger your saving per dollar contributed. When you let that run, the compounding gets serious. If our $120,000 worker channels about $11,400 net into super each year for 7 years at a 6% return, modelling based on ATO tax rates and standard fund examples suggests they end up with roughly $94,000 more at 67. That is the difference between treating Iraq TTR as a tax play versus just cutting work hours. Move 2 is setting it up safely. Log into your super fund and look for transition to retirement. Confirm you are between 60 and 64 and still working, and check the minimum transfer amounts, which are about $10,000 at Australian Super and $20,000 at Aware Super per their 2024-25 disclosures. When you model your income, start near the 4% minimum so your balance has the best chance of growing rather than shrinking. Move 3 is the one people forget, and it is expensive. Set an explicit trigger date to convert your TTR into a full retirement phase pension once you actually retire or turn 65. Many funds, like Australian Super, auto-convert at 65, but only if you tell them you have stopped working. And at that point, your earnings tax drops from 15% to zero. Here is how much that mistake costs. If you have $600,000 sitting in TTR earning 6%, that is $36,000 in earnings taxed at 15%, or $5,400 a year. Delay switching to a 0% retirement pension for just 2 years after you could have, and you have leaked about $10,800 in tax for absolutely nothing, based on ATO 2024-25 rules. The first common mistake is using TTR when you simply are not the right person for it. If your marginal tax rate is already near 15%, the salary sacrifice saving shrinks to almost nothing, and you can actually end up paying 15% earnings tax inside TTR that you could have avoided entirely. The ATO also warns TTR income and assets can affect Social Security entitlements, so even a small amount of extra assessable income can claw back the age pension. The second mistake is letting the forced withdrawals drag your balance down. Remember, you must draw at least 4% every year. So a $200,000 TTR forces out $8,000 annually. If your returns are modest and you are not replacing that money through salary sacrifice, your balance can actually shrink over your final working years, which defeats the whole point. Let us run it back quickly. Understand that TTR is a non-commutable income stream you draw 4 to 10% from. Check your tax bracket is high enough to make salary sacrifice worth it. Confirm your eligibility and fund minimums. Set a safe withdrawal rate near 4 to 5%. And crucially, plan the trigger date to switch into a 0% retirement pension. Transition to retirement is a genuinely powerful tool for the right person on a mid to high income with a solid balance, but it can quietly cost you if you use it wrong or sit in it too long. If this helped you see whether TTR is actually for you, subscribe and check out our next video on how to convert your super into a tax-free retirement income stream the right way.